people are saying, well, this is going to spike. Interest rates are going to go up. I think we're kind of going to see leveling off. I think it overcorrected down to, what's this level? Like 0.6? Like that's silly. That's just silly. I'm not even on steroids. Like that's on steroids, on coke, on crack, on heroin. Like that's just, I don't even know. Like just mind blowing how much money would be flowing at that interest rate, right? Hey everyone, welcome back to the Mark Loeffler Experience. Another great show here for you today. We're gonna be talking stock market crash. Woo! Or yay, nay, I don't know. Some people are happy that stock market's gonna crash, or is it? Well, that's what we're gonna decide today. Make sure you watch to the end of the video. So I'm gonna give you my prognostication of where I think things are going, at least in the next, till May. Let's just say till May, because I think guessing more than that, and this is just a guess. Again, as I said in my last video, I am a passive investor, not passive. I mean, I do some options trading in that. I am no expert by any means. I have a bachelor's degree in economics. I'm not some fancy guy. And by the way, they probably don't know any more than I do, and they're probably not doing anything with this. So who knows? So I'm going to show you some of the things that I'm watching that help determine how I invest in the stock market, when I'm invested in the stock market and when I'm not. Yet, if you are somebody who is investing in the stock market and is long-term, then you don't really care. All you should be doing, and you're not selling options like I am, or like some people would call it day trading, because I am doing more. You know, I'm daily doing something in the market. So I guess that would be day trading. I'm not like trying to be in and out of the market in the day. That's just not what I'm doing. But I'm selling naked puts, covered calls, and I'm buying some calls. Anyways, let's get into that. Yeah, let's basically see what I'm up to in the market. So I use tradingview.com, and I basically, this is the bull trend that we're in right now. Barring, so this is the first GME experience here where it came down below. So it gave me a new point. And then this is, what day was that again? March 4th, March 5th. So we had that little correction. And basically, you know, this is the channel I'm watching. So if it bops up above it or below it, this is when we're going to have a trend break. We haven't seen that yet because, okay, yes, we closed below it the one day, and then the next day we came right back. And basically the next day we came right back is March 5th. Like, so I was out of the market up here. I had some nice profits. I basically sat on them for a week and a half. And then I saw this, and I saw this coming back, roaring back to life. And I was like, okay, I'm gonna be back in the market because it's gonna rally up again. And we have this band here. As you can see, we're going back and forth in that band. So as long as we're in that band, I continue to sell naked puts, buy calls. I'm typically buying calls when it's around here. I'll sell more naked puts when it's in the middle like this. And then when it gets closer to the top of this channel, I'm typically going more to cash, probably 90% cash. So that's kind of just my strategy, and some of the things I'm watching that give me the prediction that I think we're going to be okay until May. And if you watch anybody, it's the sell in May and go away, because all the traders go to their fancy vacation homes. So that might be a thing. Who knows? Yeah, I mean, I can trade all the time because we do it from our mobile phones, right? So obviously a lot of people are talking about inflation is going to crash the market. And why inflation isn't good for the market is because, again, well, basically what it does is inflation goes up, interest rates go up because you need more yield to stay ahead of inflation. And that's basically what these people buying government bonds are doing. They're just staying ahead of inflation and not losing money. But what it does for the corporations is it makes it more expensive to go out there and borrow money. And if it's more expensive to go borrow money, they might not borrow money to grow as fast. That causes, and obviously the stock market is a future looking mannerism. It's not not about today's profit. It's about what they're going to do for us in the future. If interest rates are going up, then we're going to see the market come down. And so here's my prediction. This is a 1-year treasury chart, the 10-year treasury. We're at 1.64. As you can see, 1 year ago, we were over 3. We were close to 3. We went above 3. So we're still really low. Like, money is still stupid cheap. You can see here's the 5-year. So even back in 2017, when there wasn't a pandemic, even before the pandemic, so what was this, January timeframe, let's say December, October last year, right? Like, these are all, like, it's over 3%, the treasury yield. So like 1.64, it's basically almost historically low. Look, like, since 1979, it hasn't been this low. Again, like, even through like the worst of 2008, 2009, the recovery, like, we're basically at the lows in 2012 right now. People are saying, well, this is going to spike. Interest rates are going to go up. I think we're kind of going to see leveling off. I think it overcorrected down to, what's this level, like 0.6? Like, that's silly. That's just silly. Like, that's just basically the money flow. That's like, I'm not even on steroids. Like, that's on steroids, on coke, on crack, on heroin. Like, that's just, I don't even know. Like, just mind-blowing how much money would be flowing at that interest rate, right? This is the correction back up to a little bit more of norm. I think we're going to see that for probably the next anywhere from 3 to 6 months. We're going to hang out in this range. I don't think we're going to see a huge spike in yields. Like, this is the inflation. So again, we're still super low on the inflation. And I know a lot of people are going to be out there saying, well, Mark, I can't buy lumber. I can't buy drywall. I know there's shortages and things right now. A lot of people I'm watching are actually talking about deflation, which I think will hurt more than inflation. So, I mean, if you guys want, like, I'll link Alessio Rastrani down there, and he talks about how for inflation, you need to have 3 different things, and we're not seeing that. I'm not going to explain that in this video. I'll just link down below to his. And, you know, we're just not seeing it at this time. And you're seeing, like, the core inflation is still relatively low. Now, I think if you're trying to buy computer chips or bikes, construction materials, I think cars are going to be affected soon because, you know, every car has computer chips now. So, like, these types of things are going to start to be affected, yet I don't think we're going to see price increases in all this type of things either, unless you're buying it on the secondary market. But again, we're still, like, stupid low inflation. Like, look at this number. Like, we were just above 0. We almost went into a deflationary period. That's why interest rates went so low in 2020, right? In July of 2020. But we're right back. Like, we dipped to that in 2019. Just before COVID, we were around 2.5 inflation. And, you know, in the States, their target is 2 to 3%. So they're going to get that up there no matter what. And they've stated this. Like, this is a fact that this is their target for inflation. I mean, it's how they get out of the monetary or to the debt crisis that they've created is they inflate the money year over year. I mean, the Fed Chair Powell was talking yesterday. Basically, he said inflation could go over 2%. He's saying that these price pressures are temporary in the construction, in the bikes, in the chips. He thinks that the global supply chain will start to ramp up again, and we're going to start to see things from, obviously, we get a lot of our goods from China. We're going to start seeing that flow come back. And I mean, I hope he's right, because, you know, I went into the local bike shop and they just have no supply. And it'd be nice to pick up a new bike for my son. I don't need bikes. I got too many bikes as it is. People are, like, talking about the stock market being at all-time highs. Again, I come back and I'm watching the S&P. my channel here. I'm in a bull channel, and if it gets to the top of the channel, I go to cash. If it drops below that channel, like if it breaks that channel, I'm gonna go to cash. Like if I'm not already in. So I was in cash. I kind of waited. I got back in just to see what was going to happen. I'm watching obviously all these things where the RSI gets high, the slow stochastics, where you're going to start to see, okay, it's bumping up against this. And these are just, again, things I watch for my own investments. A lot of people are talking because the price earnings ratio of the market's so high. And you watch all these talking heads on BNN, CNBC, and yeah, I mean, to be honest with you, this is the third highest it's ever been, right? So here's the dot-com bubble. Here is the bubble before the '08 crash, the '09 crash there. And here we are in 2021. So yes, it is super high. Does that necessitate that it's going to crash right now? Not really. I mean, look at all these highs that it made here, right? Over time, it made this high here, it dropped, and then it made a new high. So, I mean, that could happen. Nobody can predict what that's going to happen. Like, at the end of the day, this is a backwards looking tool, not a forwards looking tool. This is actually predicting, that's the current price earning ratio. So if these companies go out there and crush earnings, like, do we know companies that crush earnings, say Amazon or Google, all these companies that go out there and crush earnings, Facebook, the forward price earning ratio might be a lot lower. Anyways, Mark's predictions for the stock market. I think we're going to stay in that bull channel until May. I don't make any predictions farther than that. I don't know, like, here's the thing. When we had Trump, when you guys had Trump, the US had Trump in office, listen, we had a great idea of what he was going to do. He was going to stimulate the market no matter what. And that was his calling. He was just going to stimulate, and he was going to buy the market, which was awesome for people who are invested in the market. We knew exactly what he was going to do. I don't know what Biden's going to do out there. Right or wrong, I'm not saying right or wrong, we just don't know what he's going to do. So, I don't know his economic policy, where Trump was very clear. He was going to go out and he was going to, grow the market. Will we see a crash in 2021? It's possible, yet it could be 2022, it could be 2023, and what's that crash look like? We had a crash, like, again, yesterday of last year, this was the low point of the market. It started climbing again. So we've only been in this bull run for about a year. Obviously, into the election, we saw some turmoil. We saw the market drop. You can see all of this, right? Like in the charts, we just go back a little bit. Here's the election right in there. Volatility. We go back. Here's the stock market a year ago. But yeah, the stock market was the low point on March 23rd. And I think we're going to be good. So anyways, good luck with your investing, everybody. If you want to reach out, definitely comment down below. Tell me I'm wrong. Tell me I'm right. Tell me I'm an idiot. Whatever you guys need to do. All right. Catch you guys in the next one.